Yeah? Yeah.
Well, good afternoon to everybody. It's so good to see all you guys. I got to greet, I think, almost everybody who came in. It's great to have you here. Today's meeting is a fun time for me. Get a chance to see a lot of familiar faces. Unfortunately, I'm not able to see everybody who's attending today. We're streaming this broadcast through Mitchell Anthony's YouTube channel today, and we have over 70 people watching the broadcast right now online. So welcome to everybody who's viewing the online broadcast right now. And we've put together what we think will be a pretty good meeting for you guys to talk a bit about, our investment posture. I mean, that's what we're here for. That's, what Mitchell Anthony Capital Management is all about, is to try to create good returns for your retirement money, for your assets. And so we're going to talk about our investment posture. Most importantly, what's ahead? And certainly we want to have some time to say hi and get to know each other, as you guys talk amongst each other as well too. But we're going to get down to it, and we're going to review what's happened in the financial markets for the last 2 or 3 years. We're going to review what's happened in the economy and the things that drive financial markets. Obviously, financial markets, don't just go up for any old reason. There's a certain environment, a nirvana environment that has existed for quite some time now, that's driven liquidity into stocks predominantly, and other assets. Real estate's done quite well, along with growth stocks for gosh, 30 years almost, since I've been in this business. I started in this business in 1987 with Lehman Brothers, and it's been quite a ride, in terms of what's happened with investment policy, what's happened with interest rates, inflation, and investment returns. And the Dow was at 800. I got it on markets 30-some years ago, and now it's in the thousands. So we're going to talk about we're going to review what's happened, but most importantly, we're going to forecast what we think is next, both for the markets and for the economy. We're going to talk about the consumption things that are kind of driving the economy right now, and the likelihood that they'll continue and maybe transition into something that might be better. And certainly we got to talk about, is there a bust on the horizon? How many people are fearful there might be an economic bust coming soon? Anybody worried about it? We've got a few. Not too many, but a few. Okay. So certainly we have to kind of evaluate what brings markets to their knees, and what's done that historically, and is it likely to do it again? And is there any rot out there in the economy that could bring the market down? almost every time we've had a market meltdown, there's been some sort of economic rot that was underlying that kind of caused that meltdown. And you know, whether the first crash I saw in 1987, or whether it was what happened in 1991 during the Gulf War and after that S&L bust and all the rot from that. Then we had another big bust in 2000 after the dot-com investment cycle kind of got overdone, and there was a lot of rot in the economy as a result of overinvestment in dot-com businesses. And then we had a great run from 2000 and 2008, 2009 for housing, but we, for whatever reason, politicians thought everybody should own a home and made it almost affordable for anybody who had a pulse to get a home. And so people over-invested in real estate. And we had a bubble in real estate that burst that took us really 2 decades to recover from. So that was the rot that brought us down then. And we're kind of just mopped up that mess over the last 10 years or so. So we're going to talk about, is there boom or bust, or what's on the horizon? Because certainly we have highly valued markets. Your accounts are probably at 50% or more over the last 3 years. Huge. You're looking at your balance. Our average client used to have about $500,000 with us. Now our average client has over $2 million with us. And so most of my clients came to me 30 years ago and said, Mitch, I've got $500,000 here. I'm retiring, I'm 60-some. Make it last longer than I do, okay? Well, you know what? Most of them have $2 million now. And most of them have lived nicely for the last 30 years. And they're just saying, oh my God, I never thought it would be this good. It's been pretty good. Talk a little bit about what we do besides manage money too. We are a wealth management firm. So I'm going to tell a little bit about some of those services. And we're certainly going to review our performance. As I said, this firm's been around since 1991 is when I started it, after spending about 7 years at Lehman Brothers. And I worked at Lehman Brothers as a research analyst for them for the first part of my career, after being an engineer. I have a degree in structural engineering, and I worked as an engineer for about 5 years out of college. And then, I don't know, I had friends working on Wall Street who were making 6 and 7 figures, and I was scratching my head saying, wow, I'm making $50,000 a year here, and you guys are making 100K, 500K, a million, and are you brighter than me? And I went, And I guess so for me, and I changed careers. I went back to business school at Arizona State, and ultimately, once I got out of school, I went to work for Lehman Brothers as a research analyst for them, and eventually became a portfolio manager, and I ran a specialized group for Lehman Brothers for many years before I broke off and started this firm, when I realized I really wasn't a great fit for corporate America. As much as I respect corporate America, I also know that there's a lot of butt kissing you have to do in corporate America to move up, and I'm more of this kind of strong-minded entrepreneur who wanted to move up because I did things well, not because I did things the way my boss wanted them. So I left the corporate environment and then independent sense, and I've loved it. So I've been around since '91. As I said, my firm is not the typical wealth management firm that the average retail investor has, who's focused on finding somebody to help him build a portfolio. We're somebody you go to because you're saying, hey, I don't know how to do this, or I can't do this well. I want to beat the S&P 500. And if you can do that, I'll hire you. And so I've built this firm to deliver performance. Obviously, there's financial planning stuff that I've done for all you guys over the years, as you've needed it. But the real crux is, what's really made the difference is the fact that my average client has made 9.5% over the last 20 years, compared to the S&P has made about 8.5%. And that's made a huge difference. So that's what I do, and that's the kind of environment that I've tried to build here. I'm continuing to try to get better at what I do every day. The investment philosophy that I have is more about growth than value. that I really want to own investments if I can that grow, and not necessarily just buying things that are cheap, that are out of favor. I would like to buy an underlying business that's growing at a substantial rate. So if I get it wrong, well, that growth will bail me out. Many times you buy a stock when it's cheap, when you know what, it just gets a whole lot cheaper because you didn't have the right timing. So I'm focused more on buying growth stocks and growth investments where there's underlying growth that has secular, long-term themes of consumption driving it that'll bail me out if I get my timing wrong when I buy it. We've seen that. I've bought some things along the way that didn't do well at first, but then ultimately they've done well, whether it's Eaton, whether it's Amazon, Lilly, Apple, NVIDIA, all of these names that I've owned that have 1,000% returns or more for most of my clients. Many times I didn't get the entry right, but the stock has done really well. I have a blog that's out there. If you ever want to know what I'm saying and doing, you can go to macmblog.com and read my most recent views. I don't know if people have gotten a habit of doing this or not. I know some of the people who are on the streaming site today have certainly done it and used the internet more as a way to kind of understand what I'm saying and doing and thinking. And so don't forget about my blog and read it whenever you can. I've got 3 guys who help me. I'm not alone. Although I have been the kind of the stable guy who's been doing this for 30-some years. And I'm the chief investment officer, and I'm also the primary financial advisor for most of my clients. But I've got Matt, who you probably met when he came in, and Jason, who you met back there before I came in, who were doing research for me. Matt's just recently got his MBA and is working on his CFA, and Jason worked for a portfolio management firm in Seattle for the last 5 years as a senior analyst there, and he's now taken on that role with us. And then Jim has been with me for, a decade or more, doing client relations work, and you've probably talked with him on the phone over the years. I have about 250 households that I work with. It's not all that I really can handle with the team that I have. And my average household size is about $2 million, as I said. My minimum to work with a new client is generally $500,000. Although I'm reducing that minimum to $100,000 right now for any of you guys who have children who are looking for a financial advisor, and they've accumulated maybe enough wealth of their own where they're saying, hey, I should probably hire somebody to help me too, and somebody who can beat the S&P 500. And so if you have children or friends or relatives, part of your extended family, we're reducing our $500K minimum to $100,000 for new relationships. And we're also offering 50% off our first year's management fee for anybody who signs up this year. So we're offering a deal for anybody who wants to come on. What my firm does and what I do is I manage capital. And I work for a management fee. And most of you guys see my management fee is generally 1% of your account value, or is 15% of what I make for you each year. And so I give you the choice of deciding what you want. The 15% of the profits and the 1% of assets both motivate me to do better, because the more, the better your account does, the more money I make. And people who have the profit-based fee was wonderful for me the last 3 years when you made 30% or more each year, and I was getting 15% of that. It was pretty good. It was triple what I'm used to getting. But also in 2022, when we didn't make any money, I didn't make any fee either on those accounts. So in the profit-based situation, if the market goes down, I don't make any money. In fact, I don't get paid again until your account passes the high water mark that we set historically. So there's a choice there. Like I say, I have skin in the game, right? I'm not somebody who just wants to work for you and when there's a draw, you're going to pay me. I'm motivated to perform and to do well. We can manage money anywhere. If you've got accounts at Schwab, that's the easiest place, and that's where almost 90% of the clients that I have, or the accounts that I manage are at Charles Schwab. But I also have accounts at Fidelity, Voya. I've got some sprinkled around at other full-service brokerage firms too, so I can run your account anywhere it is. It doesn't really matter. I'm not somebody you're hiring to sell you securities at my brokerage firm. I don't have a brokerage firm. These are partners, people who work alongside me to custody your assets and process the trades that I do and take instructions from me. But I'm not somebody who's in the business of custodying your assets. My goal is high real returns. Alpha. Does everybody know what alpha is? Does anybody know what alpha means? Anybody want to guess? Doris, guess. Come on. What's alpha? Doris knows. No? Frank knows. Excuse me? Alpha is the excess return over the bogey. Like, if I can get there. Like, my dynamic growth strategy is probably what 75% of you guys in the room have and online have. It was up 32% in 2024, and the S&P 500 was up 26%. So the difference between that is 600 basis points. That's alpha. We produce 600 basis points of alpha, or excess return over the bogey for you guys. That's what my goal is. That's what I'm seeking to do. This year, not as much, but still some. This year, my average account is up 14%. The S&P is up 13%. We got a little bit of alpha this year as well. In 2023, we had similar. We were up 29 to 30%. One strategy was up 36%. And the S&P was up 26. So we had 1,000 basis points of alpha for all you guys who have our diversified equity or growth portfolios. So really good excess return. So that's my goal. It's produce alpha. That's why I come to work every day and I crack the whip on Matt and Jason. Say, come on guys, ideas, alpha ideas. Mine's one alpha and one excess return. I'm not here, for Lawrence Welk music. So that's what my goal is. I also want to manage risk, though. I'm also trying to, be aware of whether there's a meltdown ahead. And if, when I have suffered and not done as well as the bogey, is when there's been this fear of a meltdown, when there's been rot in the economy. I've had to come out of the marketplace temporarily. And then it turned out the rot didn't turn it. The storm I was worried about didn't really ever surface. We had a little rain was all. I was worried that a hurricane might hit, dump your boat over, dump all the assets in the ocean. So I left some money on the table in some of those years. But that's part of what's involved in managing meltdown risk. Because I have to. If there's really trouble ahead, I got to say, look, I've got to kind of pull the sails of the sailboat down to half mast. I can't keep them all the way up. There's rot building in the economy that could tip the boat over. I want this relationship to be comfortable and easy for you. I want it to be affordable. The fees I charge are very competitive. In fact, I don't know anybody else out there who offers profit-based fees like we do. And somebody who charges 1% or less. Some of my legacy clients, I think, are only paying 28 or less or so. I kind of honored that, what we started that. So I want to be competitive fee-wise. I want it to be comfortable. I don't know. Most people think I'm kind of like a guy. And I kind of get the job done. I want to have well-defined financial plans. We do a little financial planning. Not a lot, but I've probably done a financial plan for everybody who's listening today at some point where we've gathered together, a spreadsheet that lists every, account that you have and kind of looked at what it's worth all now and then took different inflation rates and different rates of return and forecasted what it'll be worth, at age 90 when you're gone, or 100, or however you think you're going to last. and how much you'll have to pass on to your kids. And so we've done financial plans, and we do them and update them as needed. And there's no cost for us to do any of that. There's no cost to you to have us do any of that. I also want to invest in things that are liquid. You're not going to see me putting your money into things that are captive or proprietary or good for me, like an annuity, or like a lot of private equity funds and things that have big sales charges. Like half of what BlackRock puts out is proprietary stuff that's captive. It's got huge sales charges on it, huge loads up front. You get in it, you can't get out of it. It's not really liquid. They think, oh, we're BlackRock. We can get everything right. Well, you know, an awful lot of that stuff BlackRock produces that never produced any alpha at all. But we're going to talk more about private equity and the outlook for that, as well as the outlook for some of the newer things like Bitcoin and digital currencies and some of the things that are, you know, investment advisors that are kind of wowing you with and saying, oh, if your investment advisor doesn't have any Bitcoin, come on, he's out of touch. Right? Well, look what it's done. I think all of you probably understand what my core beliefs are, but I'll just summarize them again. I try to say this every time we get together, so you remember. But my core beliefs is that financial markets are driven by liquidity. Liquidity is what pushes stocks, bonds, real estate up. And there's lots of liquidity out there flowing toward financial markets, prices go up. Conversely, when liquidity starts to get drawn out of the markets because of some concern, it's generally because non-risk assets have started to yield a lot to kind of draw money out of risk assets. But liquidity is what drives markets. And I know that liquidity is driven by expectations for inflation, for central bank policy, and for economic growth, and in that order. When we have a great economic environment, a great market environment, it's generally because we have low inflation. Generally because we've had a central bank that's been reasonably accommodating or at least neutral. And third, that there's been good economic growth. That's kind of been nirvana, you know, for financial markets. And that's what we've had throughout most of you guys' retirement. Since the 80s when you guys started to retire, and I got into this business, Ronald Reagan and Paul Volcker started bringing down inflation, which was double-digit back in the late 70s and early 80s, down to zero for a while. And central bank policy down to zero for a while, ultimately in 2010. But we've still had economic growth. It's been modest, but we've had economic growth, and that's been nirvana for financial markets. That's the reason why we've had these great returns for 30 years. And the reason why we'll continue to have great returns going forward if we can keep this environment going. We can keep inflation down, keep central bank policy friendly. In other words, if interest rates get too high, there's no reason for us to have our money in risk anymore. If I can get 6, 7, 8% on a treasury bill with no risk, why do I want to own a stock, right? Or a commodity, or a Bitcoin, or anything, you know? So that, fortunately, it really hasn't happened though since the late 70s and early 80s when we had really high interest rates because of inflation that was crazy. What assets do I invest your accounts in? For the most part, I'm focused on assets that grow rather than inflate. You guys know what that means? Does anybody know what that means when I say assets that grow? Crystal?
I think the difference is if they grow, there's real value there. If they're inflated, the value isn't in the stock.
Yeah, Crystal's saying if there's better value for things that grow, and things that inflate maybe not. But generally what I mean is like oil is an asset. It can't grow, can it? It either inflates or deflates in value. Land, it either inflates or deflates in value. Land doesn't grow, does it? A lot of commodities don't grow, like Bitcoin. Does it grow? No. Can it inflate or deflate in what it's worth, but it doesn't grow. But does Amazon grow? How many people own Amazon? We all got it in their accounts, right? We've seen, Bezos, you know, take that firm from a little company who made a Kindle, which John Schoonover told me 30 years ago, Mitch, my Amazon, that Kindle's pretty cool. I bought it. But that company went from making a Kindle to being one of the premier companies that's providing, you know, high-density computers for artificial intelligence and helping America become smart. It's all about, the globe is all about becoming smart right now. And Amazon has grown. And so it didn't inflate in value. It isn't just like this fixed asset that inflated like a piece of land or a barrel of oil. I mean, that underlying company has grown in value. And so if I got the timing wrong when I bought it, it just kept growing and it grew through maybe a bad point of interest. So I like to invest in assets that growth. They're much better, and this tends to be growth stocks, not value stocks. I've kind of never been a big proponent of value stocks. Even though you buy them when they're cheap, many times troubled companies stay cheap and they don't grow. I want to buy companies that are going through strong secular long-term growth, and I want to ride that growth. And that's what I'm focused on, is assets that grow. Does real estate grow or does it inflate? What do you think? It mostly inflates, but it can grow because you can improve it. You can kind of think of like an apartment building, kind of like a business. And that business can you can invest in it, improve it, and kind of create better rents out of it, and it will kind of grow in value. But at least real estate can, land really can, but real estate has some growth components to it. So I'm focused on things that grow. I generally don't buy things that are cyclical growth. Cyclical growth are companies that might do well during an upturn in the economy, but then they'll falter as soon as the economy goes back through a downturn. And this would be companies like energy, financial, banks. They rise and fall with the economy. Industrial companies, manufacturing companies. You know, what's going on in manufacturing? Anything really exciting that has secular long-term growth? Not a lot. What's going on in energy? Anything exciting? I don't know. It's still about, you know, barrel of oil. What is worth finding it? So I tried to. I've bought these companies, value stocks before, but it's a tougher call because like right now, if you buy energy and banks, they're highly priced. If this economic cycle tails off and ends here, they're going to come down hard. But Amazon, Apple, Nvidia, Oracle, they're all going to keep growing right through that slowdown. They might come down to it for a while, but then they'll get up and grow again. But these value stocks, these manufacturing companies, they're going to get hit really hard. And they're not going to grow through a slowdown. So I don't tend to buy things that are value-oriented, try to focus on things that are growthy. What have we been hearing about private equity lately? Has anybody kind of heard a lot about private equity and gotten interested in owning private equity? A lot of it being advertised out there is really having high returns. You know? Anybody? Okay, we've got a few folks who got interested in it. Did you own any?
Yep.
Okay. Has it done well?
Yeah.
Sure?
Yeah.
Okay.
Cost.
Private equity is you know, by definition, is another way to own stocks. But stocks that are private, companies that are private. And the question is, are companies that are privately owned better, more growthy than companies that are publicly owned? Generally not. Generally companies that have great business plans, great visionaries at the helm, you know, Elon Musk at Tesla, Bob Iger at Disney, the list goes on, Jeff Bezos at Amazon, you know, all these great businesses, Jensen Huang and Nvidia, Larry Ellison at Oracle. These are not privately owned companies, are they? Because they want to market themselves to the public who will highly value them. They'll be able to raise a lot more money from the public than what BlackRock will get. Right? So what private equity tends to be focused on industrial, manufacturing, value names, cyclical names that are out of favor. And so BlackRock, these private equity funds are formed, raise capital, and they go out and they buy kind of troubled businesses, try to buy them cheap, with the idea that they'll put new management in place and fix them and make money on them. And they do, and they work. But I will tell you, the average private equity fund last year was up 12%. What was the S&P up when I had that chart? 26%. What was your growth portfolio up? 32% or more. So private equity just did not do well at all because it was like owning value names. There's a lot of industrial manufactured names. 90% of the money that goes in those funds goes to sales charges and commissions that BlackRock makes together. So I'm not a big fan of private equity, and fundamentally I think it sounds okay, but generally sometimes firms are incubated in private equity and then eventually go public. But I don't know. I can't think of a really great company that's private right now. Whether it's Elon Musk or Tesla or all these great companies, they're all public. I don't know any company that's out there really leveraging what's going on with artificial intelligence, super intelligence, chips, semiconductors, obesity, that's private. There are all kind of industrial stodgy names that funds have bought. So I got excited about them, and they're real liquid. These private equity funds that are put together, they don't trade publicly, and so if you want out of them prior to maturity, you're kind of subject to what BlackRock will pay you for it. And that isn't good. There's the recent performance of what growth investments have done. MACM's dynamic growth portfolio, 29, 32, we're up 14% as of yesterday on that strategy. That compares the S&P that's up 26, 26, and 13. This is what growth has done. Private equity, nothing close to that. There are some stocks that have done a whole lot better than that sometimes I wish I would have owned. But they've kind of been mania-like, and so I've kind of got a little afraid of some of these mania-like stocks that don't have sensible valuations. Anybody think of one? What's one of the names out there that's just really done terrific that you think, have you wondered why doesn't it show this? Anybody know a name or two that you've seen and you kind of wondered why I don't know? That's been a stellar performance. Nothing off the top of your head. There's certainly been Palantir, CoreWeave. Everybody know what Palantir is? Palantir is a company that makes enterprise software for big, huge corporations or the government, the Department of Defense, and they're implementing enterprise software that has artificial intelligence applications built into it. Sounds really exciting what they're doing. But they sell it 200 times the year ahead's earnings, and they're only growing at about 12% right now. It's kind of that valuation that scared me out of it. Kept me away from some of these things that are valued so high. They kind of fit what I want to own because they've got great secular growth. But I do know if you buy one of those and then they stumble, it might take a decade to get back to where you were. So I have kind of stayed away from some of these mania stocks. I mean, Tesla was like that. I looked at Tesla many times over the last decade and said, oh gosh, I love Elon Musk. I love what he's doing. He's a visionary. He's got all these great plans for robotics and artificial intelligence. But the stock always sold at 100 times earnings. And I'm worried if sensibility ever hits, it could be trouble. And that stock was $500 and all of a sudden it was $250 and half. It's trying to recover now, but it just can't. kind of had a problem with the valuation just getting too far ahead of what Elon Musk could really do and what some of these visionaries could do. I mean, Oracle looks like that a little bit now too. Oracle had a huge move when they announced that they're going to become the fourth hyperscaler, the fourth company to start producing, web-based artificial intelligence. And huge, talking about huge backlog for what they produce. So we're going to talk now a bit about the outlook for the things that drive the markets. We'll talk a little bit about how they've done, and then we'll talk a bit about what we think they'll do next. And we're going to look at what's happening in kind of the places of the world that matter. What matters is what's going on in America, because we're the biggest economy in the world, if you don't know it. Over $29 trillion of GDP is produced in America. When I was doing this seminar 20 years ago, I was saying $4 trillion, and thinking, oh my God, $4 trillion economy, that's 29 trillion. Wow. So obviously what happens in America means a lot. We're going to talk about China, because that's the second largest economy in the world. And then we're going to talk about what goes on in Europe. There isn't any company on its own that's huge in Europe, but combined Western Europe, it's kind of powerful. We'll look at Eastern Europe and Russia a bit, but for the most part, they kind of don't matter much. Because those economies are just not large and powerful, and this guy who runs Russia is more focused on kind of seizing things and growing as economy. Then we'll look at some of the emerging parts of Asia that look interesting, like Laos and some of those areas. Let's first talk about what's going on in America with inflation. Because inflation is the biggest driver of what's going to happen in the markets going forward. We know that when this, what did I do? This spike here, this was in 2022. This is a long-term chart of inflation, of the CPI. And you can see we've had some spikes in inflation over the years. In the 40s, inflation got up to 20% briefly, and then fell and went negative. And then we had inflation built in the 70s during the Nixon era, in the Carter years. Because we had some central banks that just really didn't know how to control prices. And so we had some very high inflation of over 15% for a while. And then Volcker got in office and Reagan and kind of started acting sensibly. And for the most part, we went through a long period of disinflation, not deflation, but disinflation, lower levels of inflation, until this point here, in 2020, 21. What happened there? Why did all of a sudden we have a spike of inflation up to almost 10%? Who remembers? COVID, right? COVID shut the economy down. Why did that cause a spike in inflation? The whole world kind of shut down economically because we were fearful COVID was going to kill us all. We had to hide inside. But why did prices go up because of COVID?
Feds put money into the system and supply them.
Saul Ortas says the Fed put money into the system to fight COVID, didn't it? It wasn't just the Fed, it was central banks around the world were concerned that COVID was going to put us into a global recession we'd never get out of. So we poured an incredible amount of money on the problem. Printed money, gave away money. The Federal Reserve, pumped almost $4 trillion of money into our economy. And I shouldn't say the central bank did it. Congress did it. The Treasury did it. Treasury was giving money away almost. I got $500,000 of free money from the government who was offering forgivable loans. And businesses could get kind of almost free money during COVID. Now, I thought it was silly and stupid. But consumers got a lot of money dumped in their hands, and they went out and spent it. And the rest of the globe did it. I think the globe combined put almost $40 trillion of money into consumers' hands. And as a result, it caused inflation for a while. And it started an inflationary cycle that we're still reeling from. As much as inflation's back down to 2.9% now, what does it cost to go out to dinner now? Anybody been out to dinner lately? Oh my God, you know, what used to cost $50 for two people to have dinner is now $150.
Yeah.
A round of golf is $400. I can hardly afford to play golf anymore. And it's just prices, even though prices have stopped going up, it's the level of prices that are still problematic. But we had some terrible inflation that went on for a while, and we've kind of got it down, but the problem's not over yet, though, because of the fact that it inflated things. So this is, you know, we've had this problem occur, and every time it's happened, it's taken a decade to recover from it. Generally about a decade. Every time we've had an inflation problem, it's taken a decade for us to kind of grow into those prices. Because generally, we haven't ever had deflation where prices go down to kind of give us relief. Like what do you think is the chance that that $100 dinner will go back to $50? Will that round of golf at Pelican Hill that cost $500 go back to $250? No. They don't go down. What happens is they go up and then they sit on a plateau for a long period of time, and it takes 10 years for all of a sudden you to kind of get used to the fact, okay, I guess $150 is okay for dinner now. Because wages have grown and people's wealth has grown, and now it's more affordable. So that's what happens, but it ends up putting a really big damper on consumption for quite a while because of that high level of prices. So we've had this problem before, and we're having it again. And it causes things to inflate. The good thing, though, is what's happened to real estate as a result of inflation. What's your home worth? What's your rental properties worth? Went up a lot, right? Wow, I bought a house down in Laguna Niguel. My wife and I bought a house 20-some years ago for $500,000. It's worth almost $4 million now. You know, it's inflated in value. And I couldn't afford to buy it now. I don't have to buy it, but it's crazy how prices of real estate have went up. Here's what's going on in the globe. I can't put a graph up there for every place in the world that matters, but I've tried to put what's going on with inflation for the parts of the world that I think matter. And America's inflation is down to 2.7. Stubborn inflation still kind of haunting the UK at 3.5%. Japan still has 2.9. And this is high for them. They're used to 1% or less. And so that's not tolerable for them. And so they have interest rates about as high as they've ever had, and they're trying to stop it. Europe, for the most part, though, has seen inflation drop down below 2%. Italy 1%, Germany 2.2%, Canada 1.9%, France 1.3%. China has had no inflation at all, if you believe them. I don't know. Can we believe them? Their prices have only went up by 0.2%. India is a little more honest. I think the inflation in India probably is the same as China, but they say they had 4.6% inflation last year. So inflation isn't down throughout the whole globe, but we've made a significant change in it. And as a result, central bankers are changing policy and interest rates have come down into the friendly zone. But that doesn't mean that growth is suddenly going to start. We know that central banks realize that if they lower interest rates again, that inflation will come right back. So what did the Fed do today? Anybody listen to the quarter point? Right. He lowered Fed funds down to 4 to 4.25%, which was kind of expected. But we're still a long way away from what we're kind of got used to. With 4% Fed funds, that's still 300 basis points above where it was for the most part over the last 20 years. Since 2000, the Fed has had interest rates near zero, between 0 and 1%, with an oxygen mask on a very sick patient. And so we're still significantly higher than what we've had historically. But yeah, here's a graph of it right here. You can see we were at 4.5, and now we're in the 4 to 4.25% range. Is what it's been. The Fed raised rates substantially from almost zero. It was at 25 bips in 2022. Raised them all the way to 5.5 to 5.75%. Now it's come down 1, 2, 3. Today was the fourth decline. I don't see interest rates on Fed funds ever getting back what we had, for most of the last 20 years. I think that was an unusual situation, and I suspect that maybe the best we'll ever do is get interest rates down to 3, maybe 3.5. And we'll talk about what that means. Let's now talk about what's going on in the globe with growth. Global GDP, believe it or not, is over $111 trillion. That's how much GDP is produced in the globe. And that grew by almost 5% last year from the previous year, 4.8%. Who's the largest contributor to GDP? It's America. America, 29.2 trillion. 26% of the total, and that was 2.8% growth over 2023's. China is kind of a distant second, though. They're at 18 trillion, and they're growing faster than us at 5%, although that's kind of the slowest China has grown in 20 years. And then you get to Germany, 5 trillion, so a big decline from 19 trillion down to 4.5, down into the 4s here. And there's kind of the big two here. Most of the growth happens in America and China, right? China because of their huge population, and America because we're wealthy here. We're wealthy. China's not near as wealthy as us, but they got a population of 1.5 billion. We've got a population of 350 million. But yeah, we're so much bigger than them because we're wealthier than them. So that's kind of what the breakdown looks like. But you can see really nobody's growing anything exciting, right? India 6%, Brazil 3%, China 5%, the globe at almost 5% because of those emerging economies. But generally, wherever there's been high growth, it's been accompanied by high inflation, which didn't make the growth very meaningful. If your economy grows at 4%, but yet you have 4% inflation, you're going to get ahead. So that's the growth we've been having. The question is, will it pick up or will it decline? What do you guys think is ahead for economic growth in America? Do you think it's going to get better, and this economy is going to strengthen, and the growth is going to broaden out? Or do you think we have a long cycle of just kind of soft growth? Or do we have a bust ahead? Anybody want to speculate? Wow. That makes sense. What do you think? Oh, no. Yes, they're right most of the time when I talk to them. Well, to decide, let me think. There's a few things that drive economic growth. One is what's going on with consumption. Every good cycle that we've had for economic growth has been accompanied by some sort of consumption thing. It's driving things we want to spend money on. When we had our strongest economic growth was actually during periods of here's a graph of GDP in America, and you can see our strongest GDP when we were up in the 4s was in the 90s, right? We had GDP many years in the 90s over 4%. then it kind of busted in 2000. But this was the dot-com era. And besides dot-com, we also had a great cycle for housing going on in the 90s too. I bought my first house in the 90s. That's did a lot of people. And people were buying up. There was a great cycle for housing. Interest rates were coming down. And so between housing and dot-com, boy, the economy was going pretty good. So this is the best economic growth we've had in America in 50 years. And it kind of busted with dot-com. It tried to get going again, but really, there was too much rot. There was a lot of rot that was accumulated in this phase here, and we couldn't really recover from it. And then since then, you can see, look, since 2000, since 2010, GDP's been in a 2 or less period, except for 1 year during COVID, because of all that money we put on the problem, had some strong growth. It actually came after we had negative growth for a year or two as well, and so the average those two out, and it was really just 2%. And so for 15 years, from 2010 to 2025, economy has not grown at a very good pace, 2% or less, which is not really exciting. But it's been nirvana for the financial markets, because generally investors prefer slow growth because it generally means low interest rates, and it generally means friendly Fed policy and low inflation. And so financial markets do their best when this happens. And this is when the stock market grew, right? So that's what's happening with growth. There's some good consumption themes ahead for us. If the economy is going to do well, we're going to get out of that 2%, off that 2% line that I just showed you we've been on, with GDP number averaging more than 2. We're going to get back to that 3 to 4 to 5% kind of growth we had in the 90s. If that's going to happen, we have to have some sort of consumption that picks up and drives it. A good theme of consumption. And generally, that has involved housing in the past. We've hardly ever had a great theme for consumption when housing didn't do well. And so without housing, generally you can't have a good economic cycle. We do have some other things happening, though, in that the world wants to become smart, doesn't it? What do you guys think about this, all this talk about artificial intelligence? What's going on with it? Think it's good or bad? How many people are excited and think it's going to be great for the economy?
Doesn't matter.
It's good and bad.
Good and bad.
It doesn't matter. It's here to stay.
It doesn't matter?
It's here to stay.
Because what?
It's here to stay.
It's here to stay. Well, I'm not sure what you mean by that. I mean, artificial intelligence is something that we're trying to develop and build, and it's about making the world smarter. But to do that, we have to spend a terrific amount of money to do it, and it's not really being monetized yet. For the most part, investors are handing up huge amounts of capital to build out artificial intelligence, to build out these web-based supercomputers that right now they're doing inference-based computing, which means that they can kind of forecast they can give you answers to questions based upon inference, which is somewhat accurate. It's not as accurate as a reasoning model that uses more analytical methods to tell you what's next. And it's certainly not super intelligence. So there's kind of like 3 phases of the smart world coming. The first one is inference-based computing. And this is what companies like Amazon, Google, Microsoft Azure, and now Oracle are spending money building out inference-based computing. Sam Altman at OpenAI has built ChatGPT, which is an inference-based artificial intelligence engine. Then you can ask it questions, that's great. Man, has it helped my research process? If I want to build a thesis for owning, I don't know, for owning NVIDIA, I just ask it, it'll build a whole thesis out for owning it, and it's pretty good. And then I can try to knock holes in it. So you know, this inference-based computing is reasonably good, but it makes errors a lot because it's based on drawing inferences from data, not actually using reasoning models that are much more accurate. That's what's next, and that's what NVIDIA is trying to build chips for. Their Blackwell chip is going to be used for reasoning models that are more accurate. And then after that is what's called a superintelligence phase that comes, which is where you basically take all these reasoning models and apply them to where they can basically do anything better than a human can do. And so America is investing and wants to become smart. And what does that mean? That means we have kind of computers to kind of assist us and do everything for us. You know, we all have a personal bot. We all have a robot at home that's like our assistant who can do anything we want, tell us, stand at our side, tell us what we need to do, answer questions for us, prepare our lunch, prepare our dinner, tell us where to go shopping at, tell us anything we want us to do, manufacture something, go out and do the gardening. So these are kind of what's being planned and envisioned by some of these companies, these personal bots and robotics. And the demand for chips and software to make all that happen is huge though. And that's why companies like NVIDIA have very bright futures, because all these robots have to have chips in them, don't they? They have to have NVIDIA chips in them so they can be smart. There has been some talk recently that's saying, oh, you know, all you got to do is make these robots connect to the internet, and they don't have to have their own computing power. And they can use the computing power of chat through an internet connection. And Jensen Wang came out and said, well, I don't know if that's right. He said, what happens if the robot loses this connection to the internet? It just fall over and become a big paperweight, can't do anything now? Because he's in an area that has no internet. That's kind of the problem with robots that are based upon having super intelligence from the internet, is that without a stable internet connection, it's no good. But anyway, this is a great theme of consumption, and it's gonna, right now, it's just all the companies that are inventing it are the ones who are creating the super intelligence engines that are being sold, like chat. And, you know, Elon Musk product, or Llama over at Meta, Gemini at Google. They all have their different versions of artificial intelligence. And the software companies haven't really kind of gone on top of that yet. There's going to be a great investment period for buying the software companies that actually run on top of these artificial intelligence engines that are being built right now. So we're just in the first inning of that game. The other consumption theme is experiences. People still want to do things. People don't. Most of you guys have, you know, you're spending your money traveling and going places with your kids and grandkids, and it's not about having a nice car in the garage or a Rolex watch. It's wanting to have experiences. It's sticky and it's involving. You probably have those home ownership. We can't have a great economic cycle when interest rates are so high, can we? Because it affects home ownerships. Right now, a mortgage costs 6.5%. If you're, anybody got a granddaughter or a daughter or a son who's out trying to buy a home right now? Probably. And what have they found mortgage rates to be? Pretty high. Pretty high. And has anybody in the room refinanced their mortgage in the last year or two? Or sold and bought a new house? Nobody's doing that. And the reason why is most of us refinanced our mortgages at 3% when rates were down by 10 years ago. And now, if I sell my home, I don't want to give up that 3%. So nobody's selling homes because they don't want to give up their low mortgage. So it's creating kind of a difficult outlook for housing as a result. And so housing stocks aren't doing well, and housing-related stocks aren't doing well, and the number of new homes being built is half of historical levels. This is a graph of consumer confidence over the last 5 years. You can see that, before COVID it was up at 130. And then during COVID it dropped to 85, really fell off. And then when we poured a lot of money on it, it almost came back to its highs, but then it just keeps getting worse and worse and worse. So consumers are kind of saying, well, I'm not very confident right now. This is not telling the story of stronger growth. At least consumer confidence is. But this has not been a good indicator, historically, of what consumers do. Many times consumers will moan and groan and complain, they'll still go out and spend. This is an interesting chart that's a major problem for the economy. It's something that has kept the U.S. economy down, and particularly China down. In fact, the manufacturing sector is in recession. This is the PMI index, which measures what's going on in manufacturing. And anything below a reading of 50 indicates a recession. And manufacturing's been in a recession for the last 3 years now. It was bordering on it before COVID hit. It then pumped way up, and we brought all kinds of things with that money we got, but now it's fallen. We've been in a recession to where home builders, appliance manufacturers, air conditioners, industrial manufacturers, they're all struggling right now because there's no demand for manufactured goods because of what's going on with interest rates and because housing is in a slump. Housing is the key to it. Our economy has kind of been supported by a pretty strong job marketplace. And employment has been strong. Unemployment is like 4%, close to historical lows. And during COVID, job openings really came up all the way to 12,000, an all-time high. But now it's falling to where, the latest reading is around 7,000 new jobs that are out there, job openings, which is kind of small in a world of where 60 million Americans work. There's not a lot of new jobs that are being created right now. And so the people who are bearish on the economy point to the fact that there's not a lot of jobs that are. As I said, despite low confidence, consumers are still spending money though. This is a graph of retail sales going all the way back 15 years. And it just keeps going up. It spiked down during COVID, then it recovered and it just keeps going higher. So even though consumer confidence is going lower, consumers just keep spending more and more money. I guess it's wealth-based consumption. They say, well, my stock portfolio is $12.5 million, $1 million. I'm still employed, I'm still working, and so they keep spending. So retail sales doesn't point toward a recession ahead. We looked at these GDP numbers already, and we had great GDP for a while, but this is what we're faced with. The real question is, what's ahead out here? We've got to go back to this 4 to 5% range that we had during the 90s. Are we going to stay in a slump here? China is important to look at. China has slumped dramatically. This is what their GDP has been. What it was, back in the 90s and through 2010, they were experiencing really strong growth. 10 10, 12% per year, really growing at an amazing rate. But now you look at the more recent growth rate and it's fell in half. They're at 5% of what they were at, and it seems to just be trending lower. Anybody have an idea why China's struggling and why their growth is slowing down? Is it just becoming a mature economy that can't grow as fast? Or does it have something to do with what's going on in the globe? Any thoughts? China is, the largest manufacturer of goods in the world. The economy is predominantly manufacturing. They don't produce a lot of services. They don't innovate technology. They don't produce, financial services. They manufacture things. They run factories and manufacturing facilities. And so what is that dependent upon? Housing. It's depending upon, the consumption of housing and housing-related products. And we just said housing's in a slump, and it's been in a slump for a decade. And so this is the problem that China has, is people aren't manufacturing things. And now further, Donald Trump wants to take away, a lot of the manufacturing of tech products that are done in China and bring them home and try to build up our manufacturing base here. And it seems like it may happen to some degree, so this is more problems for China. So the outlook for China is not really bright. So in review, when we think about the things that drive markets, as we try to now forecast what's ahead, we have to look at inflation, Fed policy, and growth. Inflation has been a problem. It was high and it went on too long. As a result, prices are high. And those high level of prices are going to keep consumption down. As much as retail sales is growing, it's not growing fast enough or at levels high enough to get us back to a 3 to 4% rate of growth in our economy. High level of prices is going to be a major impediment towards stronger growth ahead. And so this is a problem. Real estate's inflated, which is great, it gives us wealth, but also real estate is owned with 3% mortgages, which nobody wants to turn over. Fed policy is pretty much neutral now, but those 0% interest rates that we had that equated to 2 to 3% mortgage rates, they're not here yet, though, right? The 4% Fed funds kind of works out to about a 6 to 7% mortgage rate. How many people want to give up their 3% mortgages to go buy a new home and borrow money at 7%? Nobody's doing that. As a result, home sales are half of what they've been historically the last year. Half. So we know that even though with Fed policy kind of neutral, we still don't have this highly stimulative environment to get growth going good. And at the same time, we have high prices as an impediment towards strong growth. So economic growth, it's likely going to be subdued. There's no great consumption themes driving our economy. Housing isn't working. So our forecast, well, we're forecasting 3% inflation. I don't think the inflation is suddenly going to go to 0. I think there's so much pressure for the Fed to lower rates that maybe he will lower them a bit, but it'll probably keep consumption still high enough and keep inflation from falling back to 0. So there's no return to 1% inflation or ultra low mortgage rates, which means only modest consumption right now. We also know that wages haven't kept up with prices, so loss of purchasing power. Fed funds, we think, will likely reach 3.5% from the 4.25 level it's at now. Another 75 bips, but I don't think you'll see mortgage rates get any lower than 5.5%, which will not be a motivation for anybody to sell their home and give up the 2.5 or 3% mortgage. So I think economic growth going forward is only 2.5% at best, I don't see any great consumption themes driving the economy. New home sales and existing home sales are half at normal levels. Consumption is slow because of the level of rates and the prices of things. The industrial sector is in a recession. Cyclical industrials are struggling. You know, companies that make things are struggling, make goods, make, you know, stuff that's used in homes. The tech and AI build out and travel are the best part of our economy. But they're not strong enough to give us 3% growth. So now let's turn that economic forecast into a forecast for the market. What's ahead for equities, most importantly, because that's where we're invested. What's ahead for equities? Well, I don't see this as a time to go out and buy energy stocks, right? Anything that's kind of cyclical and needs 3-4% economic growth, not going to be a good place to be, despite, yes, we got a question in there.
What's happened when they replace Powell in May next year?
The question is, what happens when they replace Powell?
Yeah.
Yeah, I guess that's a good question. In terms of will the Fed maybe become a bit irrational? I think the Fed has been pretty rational, believe it or not. As much as Trump, you know, wants rates lower and whatnot, the economy is kind of not positioned well right now because of the problems we have with inflation. Lower rates would cause stronger growth, but it would just push inflation right back up again. And we'd just be in a worse problem in 3 years from now than what we're in now. So I don't think what Trump wants is really good for the economy in terms of lower rates. And will he put somebody on the board that might press and somehow make that happen and cause the Fed to become a little irrational? I kind of don't think so. I think we'll probably, whoever we get, will probably still realize that, you know, central banks got to be smart and steady, and maybe Powell's been a little too conservative, not too much. I just don't think he's been too far off. He's been late. He's always late at doing what he's doing, and I don't know if the economy does fall into a recession here for the last year, he'll get blamed, but I kind of don't think we will. I think what's ahead is kind of just slow growth. I don't see any rot in the economy. When we were reviewing the economy, did we talk about rot? Did we talk about overcapacity? You know, generally when you have a problem brewing in the economy that will cause a bust, you've had like some theme of consumption that really got big that kind of caused too much capacity to get built for it. Whether it be housing, manufacturing, or .com stuff, or technology. I mean, some people think maybe we're in an AI bubble, and that could be caused. And not really. I mean, we're building out a lot of AI because just if we're going to move into a super intelligent phase, these engines have to be built. And fortunately, you know, investors have been willing to ante up the capital to do it. And we're not monetizing it very well yet, but eventually we will. So I think there's slow growth ahead. I don't think this is the time to own value stocks or cyclical companies that need a stronger economy. We don't want to own retailers. We don't want to buy Target or Walmart. We don't want to buy energy companies or banks. We don't want to buy industrial names that make pumps and engines and anything tied to housing. We really want to be invested in these kind of themes that are driving the economy that I've talked about, which is artificial intelligence, which is digital devices, obesity. And 40% of America is obese. Kind of hard to believe, isn't it? 40% of America is obese, and looking for ways to kind of shed that weight. And so, you know, we own Lilly, which is a good company. I haven't made a terrific amount of money on it yet, but it's a good company. It's got solutions, and there are a few other companies there. So I think they'll do well as we get Medicare to kind of chip in and pay for some of it and help it become more affordable. I think entertainment and leisure will do well. There's a theme there driving that. I think digital devices and digital payment base supercomputers and build out of all the infrastructure for a smart world will do well. We're just going to have slow growth. I think we want to stay in these mega caps that have secular tailwinds behind it. So I think the growth equities are the place to be. I think the U.S. is the best engine of growth in the globe, with America investing in smart technologies and AI. And this AI investment is mostly in benefiting these mega caps. These private equity funds, they don't own artificial intelligence companies. They own industrial names that are struggling in housing. So this is where we want to be. Fixed income, maybe there's a little upside in bonds as rates drop a bit, but not a lot. There's anything really too exciting going on in the world of fixed income. These are kind of just value traps, assets that don't grow. Real estate, I think prices are pretty inflated, but they're probably going to trend a bit higher. I don't think you have to worry that your rental property is going to crash and you should sell it, or your home. I think real estate prices are going to stay high. I think commodities are, the move there is mostly behind us. And the upside is minimal. They're tied with, commodities are generally tied to a stronger economy, whether it's copper or steel or oil. Maybe things that are tied to energy, like uranium. I mean, we know that to build out artificial intelligence, we need power, don't we? And so power companies look appealing. So we've been spending a lot of time trying to find our favorite power companies to invest in. So we can make money as we, realize we need double or triple the amount of power that we can build. And it's probably going to come from these new breed of nuclear facilities that are being innovated and developed. So we're going to invest there. Bitcoin and stablecoin. How many people would like to see me buy some Bitcoin in your portfolio? Anybody feel like, wow, I'd like to have it? Got a few people. Would anybody oppose it if I did it? Would anybody get angry if I did it? Yeah. I generally want to invest in things that are sensible and things that are growing. Right?
Military.
And so does, somebody said military?
Yeah.
There are military applications for Bitcoin?
No, but military applications in general with the growth of our military forces.
Okay, I agree with that. Trying just to kind of talk a bit about Bitcoin and digital stuff right now to kind of help people understand maybe why we're not there. It's kind of a mania. Bitcoin doesn't grow. It's not a growth stock. It's more of a store of value. And it's not like you can it's not like a company you can see it being invested in, built, and growing, like what was going on at Amazon, what you can see happening now with Oracle, and NVIDIA, and Palantir, and CoreWeave, and all these companies that are out enabling artificial intelligence, or even companies that are out there enabling what we're doing in the world of travel and leisure. We own Marriott and Hilton hotels and things like that. But Bitcoin is a digital currency that people somehow think we might find a reason to use at some point. But thus far, we haven't really found a practical, usable thing to do with Bitcoin. We haven't found practical uses of it yet. It's very expensive to do transactions in it because it has to be converted to dollars in some manner or some currency, and you have expensive transaction costs. So you can't buy your groceries in Bitcoin, and that won't make sense. And for the most part, it's only used for transactions that are black market based, where you're really trying to hide purchases from that. But yes, sir.
Just an unusual observation of that. We spent our summer in Oregon, eastern Oregon, had some spare coins that we wanted to turn into cash. So we go to our local supermarket to feed them into an ATM-like machine, and what comes out are bitcoins.
And they pay you back in Bitcoin.
Right. So there are all these automated ATM-like things where you put in your cash and you get crypto.
Right. So and he's making this point that and how meaningful is it the fact that a lot of people are kind of forcing you to convert cash to Bitcoin because it's cheaper for them to kind of give you this digital currency. I think that's the reason why we're coming out with something called a stable coin now, which is not a Bitcoin, but they're kind of digital currencies that are pegged to the dollar. And Bitcoin is not pegged to the dollar. It's one reason why it's expensive to do transactions in it. The stable coins are pegged to the dollar, and so they'll have very low transaction costs. It's a way that you can pay for things digitally with a stable coin. But it doesn't really overcome the problem of having. The whole idea of a digital currency is to have something that's not denominated in anybody's currency. It's a currency of its own. And so it doesn't really alleviate that. And it's not a whole lot different than just when you digitally pay for something through your credit card. So, I don't know, it's just they sound more exciting than they are. They're not very practical. And there's a mania driving it. But it's not like I can look at it and say, oh, here's this company. Like Amazon, I can tell you how much it's going to earn in the year ahead, or what I think it's going to earn, and I can see how it's valued, and I can see what it's growing at, and I can forecast how we make money on this based upon how it's been valued. But it's really hard for me to kind of forecast where Bitcoin will go. When does the mania end? It's kind of like, what were those mania stocks that ran wild for a while that were driven by the traders? GameStop. Yeah, GameStop and some of those. There was no sensible valuation of GameStop at all, but there was a mania driving. And if you got in early and then got out before the mania ended, you could have made money, but most people ended up writing it all the way back down again to make the money out of it, because there wasn't nothing sensible about it. So this is the problem we have with Bitcoin, is that you can't sensibly value it. So it's very hard for me to kind of justify putting retirement money, you know. Everybody in this room, when you got with me, is your life savings. You said, Mitch, make it last longer than I do. Can't run it out. It's got to last longer than I do, and I want to do well. But I don't want to take unusual risks. And so I just haven't been able to say Bitcoin fits into that. And probably won't until there's maybe a stable coin that comes out that actually I can see how it could get played out. But I kind of prefer, you know, what's going on with credit cards and how they're digitizing. Apple has got digital currency payments, and I own Visa, which you've seen, which has done really well, which makes money with the digitization of payments and stuff. I think that's a better way to kind of play this theme of digitization of currencies. So, you know, for the most part, I'm taking a picture of me continuing to stay heavily in stocks. Not really planning to invest in bonds right now. I don't think interest rates are high enough. And I don't think interest rates are coming down much to give you a high total return. Like, I had a lot of your portfolio in bonds back in the 90s and into the 2000s because we were getting 7% or more on fixed income. And I saw rates coming down to 2%. Because of what was going on with inflation. I saw this disinflationary theme in the world, and so I saw the total return in bonds being quite high when we combine the income plus the appreciation. But now we're kind of going back the other way. It seems like we're going back to a normal interest rate environment. I don't see rates ever coming back down to 0 or 1 or 2%. And so the total return in bonds is pretty low. And I just don't think money's going to go there in a year or two ahead. So I'm kind of thinking this is an equity marketplace, and it's really about secular growth. I want to own companies that are growing, that will lead the market to new highs. I think valuations are secondary to growth, the sustainability of growth. I mean, I'm tempted to buy Palantir, you know, it's high PE. Oh my God, it's just got great growth potential. All of these enterprises that need artificial intelligence solutions, Palantir is right there, and companies are lining up to do it, and same with Oracle and Microsoft's building, we own Microsoft, but I don't own Palantir, I'm probably going to buy it at some point. The sustainability of the growth is more important than the valuation, particularly if I believe that there's not a lot of rot ahead. There's not a lot of rot in the price or a lot of craziness in the price. I like companies where there's the visionaries at the helm. You know, this guy, Kurt, who runs Palantir. What's the guy who runs Palantir, Jason?
Oh gosh, sorry for Palantir, sorry. I was fixing the camera.
I'm putting Jason on the spot.
Alex Carp. Alex Carp.
Karp.
Carp, yeah.
Yeah, Alan Karp. Anybody seen Alan Karp or listened to him? Quite a visionary. And he's got great ideas about implementing superintelligence into enterprise software and helping the government, you know, have command centers so they really know what's going on, you know, with Social Security and even at the post offices and those places, right? We've got great plans for implementing these artificial intelligence-based pieces of software to help enterprises run more efficiently, and it's needed, and companies have the money to do it, they're going to do it. And so the sustainability with a growth, with founders and visionaries at the helm. You know, that's what's exciting. Those are the companies we want to own. I think web computing, Bill, we're only in the second inning of this game. As I said, there's 3 phases to artificial intelligence. The first phase is inference-based computing. That's what we're in right now. That's what ChatGPT is. We're still just building that out. It'll take another 3 years of learning, going through the learning phase for those bots, before we're ready to move to the second phase, which will be a reasoning-based model. All of a sudden, you'll have reasoning-based models out there that are more accurate. So when you ask Chat to do something, it'll be based upon a reasoning model that will give you a much better answer that you can't knock holes in. And then after that, there's another 5 years or so as we combine all the reasoning models into what's called super intelligent quantum models that just make us, you know, give robots the ability to run the world. So I think there's lots ahead still for these companies. I think I want to get more software and service companies into the model, into the portfolio. We've got a bit of hardware right now, but we need more. We need more software-based applications. I want rising expectations. I want to own things where expectations in the year ahead will rise. Trying to avoid things where I think expectations have gotten too high and people will suddenly get disappointed. Like, are people going to suddenly get disappointed for Palantir and worry that Alan Karp had great ideas, but they're not practical, and sell the stock and expectations for what they could do fall? That's what I'm trying to avoid. And that happened with Elon Musk, and Tesla. People were so excited about him, but he really didn't get his cars on the road yet, did he? They're trying to get those, smart cars on the road now for a decade, and they're still not on the road. And still trying to get everybody to have a personal bot and the robotics idea done, and it hasn't happened yet. So expectations have come down, and so has the stock. So I think software and service companies are going to lead what happens. I think the industrial sector will stay in recession, so I've got a little bit of exposure to housing. I own, one house home builder who builds new homes, and probably not going to do a whole lot more there. I'm going to get some service companies into the portfolio, whether it's Oracle, whether it's more Microsoft, or Palantir. We're going to own some of that. And we're going to make money on it. We're going to make money on travel and entertainment. So that's kind of most of what I had to tell you about. I think, the company is going to be here. I'm not going anywhere, as much as you might say, people ask me, is she going to retire anytime soon? I'm going to have fun till the end now. I'll be here until they carry me out. This is kind of what I love to do, and I love coming to work and working with Matt and Jason and Jim and figuring out what the news flow is that day and how to react to it and how to big changes in your portfolio. Yes, sir.
I love your investment philosophy. Thank you. But you didn't mention anything about diversification. I just wondered what your philosophy is. And you didn't mention tariffs.
I didn't mention tariffs. Yeah, I guess that's a good point. He says he loves my investment philosophy and my thoughts and ideas, and compliments me, thank you. He said I didn't talk a lot about diversification or tariffs. Diversification, well, diversification lowers returns. Okay? I mean, I can diversify and own a lot of value stocks, and I won't be the S&P 500 at the time. If I own the value index, like last year, the Russell 1000 large cap value index was up like 12% compared to the growth index, which was up 25%, half of the return. I could have diversified into these areas and just made less money. So the question is, I don't diversify if I'm pretty confident I got it right. Like if I'm not very confident of what's ahead, in terms of, if I thought there was a good chance that there might be an industrial revolution coming and a big upturn in manufacturing, and that we really might have 4% GDP growth over the next few years, then I probably would want to own some energy and value names and banks and all of that stuff, and diversify to lower risk and do that. Conversely, if I thought a bust was out there, well, then I might want to own some fixed income. Might want to own some 20-year treasuries, because they go way up when things bust. I'm pretty confident there's no bust ahead. There really isn't. There's no rot in the economy. Matt, what do we think is the rot in the economy? We have talked a little bit about some rot.
High level of prices.
High level of prices. What else have we said is rot? High level of something else.
Sorry, equivalent on
Debt. Debt. Debt is rot. And debt is what brought down the economy several times over the last 40 years. When we have high levels of debt and when suddenly we can't service it, it busts the economy. That's what happened in 2010, wasn't it? Americans, consumers accumulated a tremendous amount of debt buying another home, a bigger home, a rental property, a vacation property. And all of a sudden they had all this debt and they couldn't service it. The government let them borrow, let anybody who had a pulse get a mortgage. They took out all this debt and it busted. And banks were having to foreclose on property right and left. Those are problems. That happened again in the 90s, it happened in the 80s. And so that's the rot that's a problem. It's debt-related problems. Do we have a debt problem now? Do consumers have too much debt?
Sure.
Not really. Not really. Not relative to their incomes and their asset levels. Debt levels relative to asset levels and income are about the lowest they've been in history. Who has a lot of debt?
Former college students.
College students.
There's a lot of them.
A lot has been forgiven. Somebody has a lot of debt. The government. Who took on all the debt to bail us out of COVID? The Treasury did, didn't it? The U.S. Treasury. The European treasuries. Governments around the world, not central banks, but governments around the world took on a tremendous amount of debt. We have, as much as we have $29 trillion of GDP, we have about $35 trillion of government debt. Right? That's rot to some degree. But if anybody's going to have too much debt, who do you want it to be? Somebody who can print money to pay it. Right? The government's got a printing press and they can borrow money into existence. And so they're kind of positioned to kind of service the debt. In fact, as much as America has $35 trillion of government debt, it's 1.3% of our GDP. The lowest in the world, in the industrial part of the world. Japan has 2.5 times their GDP in debt. Much of Europe has over 2 times their GDP in debt. China has about the same as us. People say, oh, well, China won't buy our debt anymore because we got too much. Well, they're all showing up at our auctions. I think there's been I think we've had a little bit of problem since Trump was elected, because I think a lot of the world does not like Trump, and they're kind of boycotting America to some degree, and our stock market got kind of hit with sales quite a bit after Trump was elected, and then as he's tried to tear up the rest of the world, I think this has caused some problems for America to some degree. But we don't have enough debt to really bring us down. And the debt, the borrow that I worry about is if consumers had too much debt and they didn't have jobs for the consumers, they're going to start to not pay their mortgages. The banks have not loaned to people who aren't clean for the last decade. Since the 2007 debacle caused banks to change their lending standards dramatically. The consumers do not have too much debt. Corporate America is rich in cash. They don't have a lot of debt. It's just the government who has a lot of debt, and they're a person who seems to be able to handle it. America is still, the safest place in the world to invest, and we still do business in dollars. There's no reason to believe that the world's going to stop doing business in dollars, and that suddenly the U.S. won't be the reserve currency for the world. So that maybe you could say is a run, but it's not going to bust our economy. I don't think there's a bust coming, so I dealt with that. So now that we're to tariffs, what do the tariffs mean? Well, I think they've hurt our image in the globe a little bit, and Europeans have kind of boycotted America as a result of it. Our stock market didn't do as well, but yet we're right back up making new highs. For a while there, Europe's stock indices were way ahead of America for the year, and now we've surpassed them. Now the S&P and Euro portfolio is up 14-15% compared to most European indexes that are only up 8-9%. So we've passed them by. Trump wants to bring back manufacturing to America. He wants to see America have a manufacturing base. Kind of a good idea. Will we get it done? I don't know. Probably not right away. I think there's kind of structural roadblocks for doing that. He's trying to use tariffs to penalize people. Like, he's kind of been saying, look, Apple, if you don't bring some of that manufacturing back, we're going to tariff the product. So he's kind of gradually forcing a lot of these players to do things in America. It's a kind of a deglobalization theme that's going on right now. 20 years ago, I was up here talking about how globalization was driving great growth because it was giving America access to cheap labor markets around the world. And so now all of a sudden, instead of having the American worker do something for $40 an hour, we were getting Chinese to do it for $4 an hour. And it allowed us to kind of take advantage of everything, the strengths around the world. We were globalizing, and everybody was part of this global dance. And now we're kind of saying, we're going to dance alone. I don't know. I think ultimately it's kind of that. Probably slow. It's another reason why growth will be slower in the world. But to me, it's back that this is a nirvana for your stock market, though. It's still the reason why artificial intelligence and smart world are going to rule. And America is where all the innovation takes place. Right? There aren't any NVIDIAs in Europe. Right? Latin America doesn't have any NVIDIAs or Oracles or Palantirs. All these great innovative products that run the world, they're all made in America. Because you can be a billionaire here. You can't be a billionaire in Europe. You can't. So this is what motivates people to innovate here. And the globe needs America to be capitalistic. It really does. And I think we will remain capitalistic. And this is one of the things I like about Trump is he wants America to be strong and pushing capitalism, which I think we need, and I think the world really needs us. And so I think his tariffs, while they'll slow the economy, I don't think they'll ultimately bring us into some sort of bust or anything. Yes, sir, in the back.
Tech companies are investing in UK. effect that will have in the United States?
Matt, can you repeat the question for me?
Tech companies that are
The
investing.
technology companies are investing in the United Kingdom. What effect that will have on the United States?
Oh, yeah, is that Mr. Grunthal back there? Very well. Very well, yeah. His question is a lot of these companies were invested in like the UK tech, in the UK and their technology, how will that have an impact on America? Am I got it right, Nat? Well, I think any technology that's built abroad and then has to be imported back here is subject to a tariff, right? But generally, services don't get tariffed. It's goods that get tariffed. So a technology that's created in the UK, if it doesn't turn into a product or a chip or something that they then sell to us and we have to buy it at a highly tariffed price, I don't think that's a problem. And for the most part, this is why I say, all the innovation comes here. We've been America's been innovating things and using laborers and people around the globe to build them. And then when it comes back here, we have problems with the tariffs applying to it. But Trump seems to be aware of this, and he keeps granting passes to anybody that's meaningful so they don't get hurt by tariffs. Just like he said, no tariffs on phones and a lot of these products. And Trump does not want to bust the economy, I think. Maybe he's reckless to some degree in what he's doing and maybe doesn't see everything the way he should. But ultimately, I think he realizes he wants a great economy and the Republicans will stay in power because he does well for the economy, he doesn't wreck it. So I don't think he wants to. Will he do it carelessly? I hope not. But yes, Bill, in front.
What about tariffs' effect on inflation? Do you think it's going to keep inflation from coming down, or is it going to force it up?
Bill's question is, how do tariffs impact inflation? And I think it's another force that makes it difficult for inflation to come back down to the zero level. This is the reason why I'm forecasting 3% inflation, 3% CPI, because I think you've got a lot of factors out there. You've got a strong employment marketplace, you've got tariffs on almost everything that's made in China and Indonesia and Asia. Coming into here at this higher price, it's just a headwind for inflation. And I think that is the reason why our economy grows slowly. It takes a while to work our way out of this hole we're in. So another reason why we've got 2% growth ahead, not 3%. But it doesn't get inflation up into a zone where it causes people to leave risk assets. And that's what we worry about. We're an investor. We've invested in risk assets, stocks, things that have risk. Non-risk assets like cash and treasuries and things that have no risk are people who go when they have high returns. You don't have to mess with risk. I don't think 3% inflation is not going to cause people to leave risk assets and buy treasuries. Unless they think there's a bust ahead and rates might go negative. For a while that was kind of happening. I remember in 2015 and 16, there was this concern that the global economy would never get out of the hole we fell into in 2010. And interest rates went negative. You guys remember that rates were negative in much of Europe? The UK had negative interest rates. You were paying the government to hold your money. Seemed kind of crazy, but it happened because we didn't have any inflation in the world. But I don't see that. See us in this world of slow growth, and hence wanting to own these great companies that will grow through it. I don't want to own companies that are cyclical and need a good economy to grow. I think what Jerry Progress said about defense makes sense. Some of these companies that building defense and not make sense too as we deglobalize and we all worry about our names, right? What else? Any other questions you guys have? What didn't I cover? Yes, Beth.
One question about AI. How do you see that affecting how does it affect your workflow? How do you incorporate AI into your workplace?
Beth is asking how am I, how are you at MACM incorporating artificial intelligence in what we do? It's big. I mean, it allows me to work with a research team of 2 people. At one point I had 6 full-time analysts working for me. And it took so much time to build an investment thesis for owning a name. Now, I don't purchase a stock until we've built out a thesis for owning it. We know we've got an earnings model, we're forecasting what we see ahead, we're looking at PE ratios. And so right now we can have an investment thesis in 10 minutes because of AI. But now we have to which then used to take a week to do. But then the critical phase is once you have a thesis, you have to hypothesize where that thesis is wrong or what's next. This is the best analysts and research is done by guys who have creative mind. This is where I have struggled a little bit, is trying to hire analysts who can hypothesize what's next and guess and dream. Because it's not an analytical search of numbers. It's really about trying to envision what's next for Apple. What are they going to do next? How are they going to operate in this world? And how is AI going to evolve? Like Jason and Matt spent 2 weeks building on a model for us to understand how a supercomputer works. Does anybody understand how these make it? How do these supercomputers that have tens of thousands of servers within them operate and work? What operating system? They're essentially they're kind of like a PC that has an operating system. Who is it? And so it took us a while to kind of better understand. There's called orchestration software in a supercomputer that runs and orchestrates what all those tens of thousands of pieces of hardware are doing. And there's all these different kind of lieutenants and generals involved in operating it. So it's trying to understand how a supercomputer works was kind of we spent 2 weeks building it out, and we're still working on it. So now we can see where does CoreWeave fit into it, where's Palantir, what is it Oracle? We can better understand what these players are doing to see if there's good upside in what they're doing, or they're just really playing. The market doesn't got it right. The average investment manager does not understand the supercomputer and how it works. Does that answer your question?
Oh, absolutely. I think when I work in Hollywood and I see it tremendously being helpful, but it's also harmful. It's changing how we do things, but it's also replacing a lot of jobs, and it's not always right.
Yeah, that brings up a good point. Artificial intelligence, this inference-based computing, chat is not always right. And I yell at Jason all the time. Jason, stop giving me this stuff that you got from AI. I want to know your thoughts. Go get the AI, but now you take that and you decide what in that ChatGPT report about NVIDIA's earnings report today, you got to interpret that and validate what's good and what's bad, because many times those inference-based reports you get from artificial intelligence are full of holes. And so we have to do a lot of work to try to validate what's right and what's wrong within them, and then try so we can forecast what's next. What else? Anything else? Do you guys like these talks? Would you like me to do more of them?
Oh, yeah.
I'd like to do more of them. I'm thinking about turning it up and trying to do at least 2, maybe 3 a year now. Kind of enjoy it. We've got a great facility for doing it. Right? If I could just get, I have 250 households, but I think there's 45 people here. Get more people to come. But we do have, sorry guys who are out there watching, we do have a lot of people watching on the internet. I'm planning to do another one. I think I'm going to plan one in maybe just 3 or 4 months ahead to talk specifically about equities and what we're doing in the equity world and what are the themes. Tell you more about what we're doing with supercomputers and what we've discovered and where Oracle fits in, where Palantir fits in, where all of these names that are exciting, where they fit into the thesis for owning them and why we're so excited about it. It's fun and exciting for me, and I love to talk about it. It's interesting for you all. I don't know what you're doing. I'll send you a survey. You can tell me what you want to do about it. But thank you all for coming today. I enjoyed it immensely. I'm so seeing you all. And I'll be around as long as you want to talk.
Yeah.